Hi, I'm Paul Kavanagh and I'm going to be speaking at the Lecture Club this evening. I'm from Killick & Co, a firm of stockbrokers, and tonight we'll be discussing why an economic recovery might not just be good for stocks, indeed it might be bad for stocks. We'll be discussing the reasoning behind that with our group tonight. Interest in financial markets at the moment because it's really at the heart of the sort of topics of which are affecting everybody's life. I mean, for most of our lives, the stock market sat in the background for people to go and play and invest in. But at the moment, the stock market is the window into what is going on in the world because it is now impacting on me, it's impacting on my job, it's impacting on my wages, the wage inflation, how much and the cost of living. I think this recession is a very different style of recession. It's not a typical recession that is being played out here at the moment. And I also think it's a recession which is not necessarily deep at the moment, but likely to persist for a very long period of time. Not necessarily in the technical term of recession, but it's going to feel pretty tough for a long period of time because there are some big adjustments taking place. But why that environment may actually represent a sort of, to describe it as a purple patch for business, but actually businesses have actually got a chance to do very well in the environment that they are in. Back in the early 80s, you would have received 12% by lending money each year to the US government. Indeed, it actually did peak here at 14. But it's been one-way traffic ever since, and this has created what we call a huge bull market in bonds. Because and again, forgive me if I'm teaching everybody here stuff that they know, but if you think about yields dropping, what you're actually indicating here is that people are prepared to pay a higher price in the value of their bonds to effectively lend to the US government, i.e. they're prepared to accept less in return. Stock markets have become much more prone now to going up on bad news and going down on good. And I wanted, if there's one message that I've sort of wanted to come out with tonight, was an understanding of why stock markets are behaving in quite different ways now to what conventionally you would expect stock markets to do. You would normally expect a recovery in corporate profitability to drive stock markets higher. But the quite opposite is happening. And it's because recessions are different. This recession is different, and it's created different thinking about the way that you value assets at the moment. Now, just